On the railroad tracks, we joked about the fact that we could probably visit all of the houses by railroad. Anyway,
by train. How disgusted Dad was that we didn't want to buy the stuff.
If your tax return is due prior to your 180-day deadline, you can't file your taxes without reporting this, so you may have to file for an extension.
Don't file your return until you've completed your exchange. Hello, everyone. Dave and Tom Moore, the Exchange Bros, and we're happy to be here with you today. It is early mid-December of 2025, and we've got a variety of topics to go over. But Cece, who's always behind the camera and the processing of our videos, sort of said, "Let's just discuss what's top of mind." So I sat down here, and I'm looking at this water. I'm like, why are we paying for filtered water? If we're going to buy bottled water, let's have an office policy. At least it's got to be something like Arrowhead that's well water, something or natural spring water.
Yeah, and why didn't we come up with this?
Exactly.
It could cost as much as gasoline.
More. Anyway, just one of those things. But hope everyone's well. Hope year-end's coming up well for everybody and getting ready for a great holiday season. And we're just going to cover a few topics I guess we've been getting inquiries on. And before we get into this, Tom, what are some things that people need to be thinking of year-end with respect to our, let's say, our 1031 clients, and then we'll sort of switch up and talk about our IRA 401k clients as well.
Yeah, and the 1031s, people need to realize that the exchange is reported in the year in which it starts. So if your sale occurs in this case, 2025, regardless of when it ends, if it ends early 2026, it's still a 2025 tax event. So the 8824 form that is used to report the exchange will be filed with your 2025 tax return. And if your tax return is due prior to your 180-day deadline, you can't file your taxes without reporting this, so you may have to file for an extension in order to take advantage of the full 180 days and get the exchange finished, and then report it for that tax return. And you also might have a situation where you do have, in the case of either a failed exchange or if you've gone down in value, you might have a situation where you've got tax exposure that may be in both years, in 2025 and in 2026. So we can talk a little bit about what might trigger that, but there's a couple of things that you need to think about.
So late year transactions, one, don't file your return until you've completed your exchange, right? And as Tom just said, if it's going to be if you're completing it after April 15th, then make sure you file an extension, complete the transaction before filing that return. But if we're in that situation where the deal does years ago, I think, you and I have been involved with this for a number of years. They're 34 years now, a little bit of time. But if you think about in the old days, people might have initiated an exchange just simply with the intent of shifting gain from one year to the next, and it might have worked for a little while, but that strategy doesn't work today unless they've got the genuine intent of completing the transaction, whatever that might mean.
Yeah,
that's not the exact verbiage in the code, but
yeah, because if you've got taxable boot that you receive in an exchange, and boot is going to be anything that you get back that's not like-kind real estate. It comes in the form of cash that might be received, or if you were to receive personal property that had any stated value to it, or if you've got debt relief. Those can all be considered taxable boot that you receive. And you get taxed on the boot for the year in which you receive the boot. And so if you had a situation where you sold a piece of property and maybe you decided to pull some cash out of that transaction at closing, which you certainly can do, then that's going to be boot received in the first year when that sale closed. If you ended up finishing up the exchange and received boot in year 2, it may be taxed in that year. So again, depends on when you receive boot. If you have a situation where you've got debt relief, then that is typically going to be taxed in the year in which the sale occurs, because it again is taxable boot. It's when the sale closes escrow, your debt's paid off. You're relieved of that debt at close of escrow. And when you go forward with the exchange, if you just spent all your cash on the acquisition, didn't receive any cash boot, but you maybe have gone down in value and did not incur new debt, then that debt relief was received in year one. If you did acquire replacement property that was equal and ended up receiving new debt, taking on new debt at the end of the exchange, then you don't have any debt relief overall in the transaction, so there's no taxable boot in that situation.
So, think about what he just said. And I guess, recently we did a video with AI, talking about AI a little bit. And since then, obviously, we've gotten other inquiries and on AI comments. And we had actually one of our own clients asked AI how to do one of the most complex transactions we do. And we're one of the only companies that have ever done these things historically, those leasehold improvement exchanges, right? And AI comes back with an answer that's totally wrong on that. But the reason I bring this up is, he just gave you a mouthful, and TurboTax is going to work well for somebody that's an employee and doesn't have income properties, let's say. But as soon as you start having complexities in your life, you're going to want to talk to people. And this is just one topic that we deal with regularly, that we spend a lot of time working with the tax and legal community on too, right? I mean, making sure everybody's on the same page with this stuff.
Yeah, and we're talking about year-end transactions. So, if you are going to have a transaction that you are getting boot out of it at the end, you may be able to structure your exchange in such a way that you switch a tax liability from one year to another year that might benefit you a little bit more. So, definitely a little bit of planning to do.
So another example of a transaction that people, I believe it's one of the most not understood, but least understood issues on installment sales. I mean, you think about installment sale, and you think about the number of people that will just go say, hey, I want to buy on a seller carry me, and the seller doesn't understand the true tax repercussions of their actions in that situation. And in that installment sale situation, I think people historically believe, well, I'm just going to pay tax, let's say capital gains tax on the principal payments and normal income tax on the interest payments as they come in. But if I don't, back to your comment on shifting gains from one year to the next, they might think, well, gee, I didn't receive any principal payments this year, so I don't have tax obligation. And that's entirely untrue, because you're going to have tax on debt relief and depreciation recapture in a year of disposition, whether you receive a single payment or not. And that's one of those topics. I mean, as far as videos out there, that's one of the topics that we get a lot of inquiries on and get a lot of traffic off that video. But I think that's one of those things where people might say, well, gee, I'm just going to sell and do a seller carry, but I'm not going to take a payment this year. Or maybe they're looking at a structured sale, which would be basically an institutionalized seller finance type structure, or a deferred sales trust too, right? I mean, those things are all sort of similar things. And you got to understand what your tax liability is there. So it's a good conversation to have with your tax people, not April 14th, but before year's end, so you can actually plan and do something about it.
Yeah, no, it's a good point. And all those are ways or methods that people are utilizing to try to structure their taxable events so it's not one big tax hit, in that same year. So, yeah, definitely something that they need to plan and be in communication with their tax and legal people with, because it's not always going to work out the way they thought it would or they intended it to.
Yeah. So Tom, when we started looking at it, you talked about boot a little bit. So you think about what is required to fully satisfy an exchange versus maybe doing, is it possible to do a partial exchange? Or as you've said, you're able to shift gains from one year to the next, but you want care to elaborate on any partial exchange is what you're looking at, or inter-year?
Yeah, and it's certainly a misconception is that to do an exchange, you always have to go across or up in value, equity, and mortgage. Okay, that's what people have been told for years. Got to go straight across or up in value, equity, and mortgage. And for a fully tax-deferred exchange, the two keys are value and equity, really. As long as you're spending all of your cash and buying something, whether it's one property or multiple properties that are of the same value as what you sold, as long as you're doing that, then the mortgage part's automatically going to fall into place. Or if you don't want to take on debt, you can always add cash to the transaction. And that addition of debt will offset any debt relief. So you can always add cash to offset debt relief, or what we say is you can add cash boot to offset mortgage boot. You just can't go the other way around where you're maybe receiving cash boot. You can't receive cash boot and offset by taking on additional mortgage boot or mortgage on acquisition. So for full tax deferral, always move all the equity across and go into something that's equal or greater in value. And when we say equal or greater, it's not necessarily the sale price. It's going to be your sale price after your closing costs. So your standard deductions from that sale price are going to be your closing costs. Real estate commissions, title and escrow fees are generally the big ones. You do that, and you'll have a fully tax deferred event. Partial exchanges are quite common, and you can certainly do so by either you can have a partial tax deferred exchange if you want to pull some cash out, even if you're going into something that's equal or greater in value. It can be a partially tax deferred exchange if you want to pull cash out. We have people that want to do that. Others don't want to pay dime one in taxes, so they'll never want to receive any cash. But another way you can have a partially tax deferred exchange is if you just go down in value. If you go down in value, that's going to result in you either getting cash boot back or having mortgage boot. And again, that cash boot might be received in year one of an exchange. If your exchange spans 2 different tax years, it might be received at the end of the exchange. So same thing with, as I mentioned, the mortgage boot. If you're selling property now and you have debt relief and you spend all your cash, but don't take on as much debt or equal debt, then that's going to be a taxable event for year one. Does that make sense?
I guess what I'd say is tax exposure is one thing, taxes owed is quite another. And back to our joking comment about with some of these transactions, working with the tax people, I think having a partially deferred exchange or having some boot in an exchange, whether that boot's like you just expressed via a reduction in the value in what you're buying or pulling some money out, typically is what we're going to be seeing in that boot situation. As you said, debt can go away, one by going down in value, triggers taxes. You went down in value. The other way is by adding cash, which is always fine. But if we look at, I think the thing that's interesting about the real estate world is that people don't necessarily look at their properties every single year and review everything that's going through their portfolio annually. I think Ron, the guy that mentored Tom and I years ago, really was an advocate of that financial planning aspect of it and annualizing the ROI every single year on those things and knowing that every year the equity hypothetically increases, your LTV decreases, your ROI decreases. And he always shamed us into selling things before we really wanted to because he said you can't afford to keep the things anymore at that equity level. But I think Wall Street does a much better job of that year-end planning. So, with that in mind, if somebody's got exposure on a gain on a 1031 that was not fully tax deferred, talk to your financial advisors, your tax people, and your Wall Street advisors, and do you have losses you can realize someplace else to offset the gains on this thing? So Tom and I like to say, having exposure is one thing, taxes owed is quite another. So when we're looking at 1031, one, as we've just discussed, it's not an all or nothing situation. In effect, every dollar you spend over the basis represents tax deferred gain. And then when you've got that situation, you have to just then talk to your tax and legal people and your finance people, your investment people, and say, okay, hey, I've got some exposure here. Can I do something else somewhere else to mitigate it?
Yeah, and most people that we're dealing with, they can certainly buy something that's of lesser value and have a partially tax deferred exchange and still greatly benefit by the exchange. Not even a comparison to a sale. The exchange is a pretty nominal fee to pay to defer capital gains taxes, and so yeah, we're dealing with people all the time that have some tax exposure on that immediate deal, but when you look at their taxes, what they might have owed or on a sale transaction, it doesn't even come close.
Yeah. So the other thing, and this is one we did sort of a segment with a couple of journalists, Forrest and Mr. Bogle, that we're talking about a different. That instead of DST, a DTS, but I think one of the things that's interesting about that, and it sort of bring it back to the comment on boot and year in which you're receiving the tax liability, or maybe if you want to pull some money out. I mean, it's very common for somebody to say, well, hey, I want to pull some money out. And you and I always ask why, right? Because we want to know whether there's a way to more efficiently or tax-wise mitigate the tax exposure by doing something differently. But you think about somebody wanting to pull money out to go put it in Wall Street. And I think recently we talked about it in one of our podcasts, just talking about, well, gee, they're promising X. Is that after factoring in a loss of 40% to tax to get there, and it never is, right? But if we look at a tendency to get into a transaction, if you want to pull money out of an exchange, you're stuck with that 1031 G6, which means either they're going to pull it out at close, and it's specifically excluded via our assignment agreement, right? That is it, paragraph 8. In that thing, something like that. I believe
so, yeah. And it's listed as retained taxable proceeds.
Yeah.
Yeah,
so you just write in what you want, and it's specifically excluded from the exchange, which it has to be that, right? I mean, a few years ago, we had some guidance federally said, look, if you just pull money out, even if you're doing an exchange, just pull money out of the exchange without it being specifically excluded, makes your exchange vulnerable, right? So our assignment agreement specifically addresses that.
Yeah, it's stated it's not part of the exchange. It goes directly to the client at close of escrow. We don't want it to be perceived as though at any point in time that it's our funds or the exchange funds that come into us, and then they're requesting it, because that would constitute a constructive receipt of those proceeds, and that creates a prohibited transaction.
So after the money gets to us, when can the taxpayer get those funds? So they can't say, okay, gee, I wanted to pull $10,000 out, go do this with it after it's closed.
Yeah, and people may have heard us talk about these G6 rules before, but if the money comes to us and the client wants to take that money out, they cannot do that, absolutely cannot do it until one of a few different things happens. If they get to the 45-day ID period and nothing has been identified, then on day 46, the exchange is null and void. Of course, funds can go out to them at that point in time. If they have identified properties to us, then we cannot release any funds to them until either all those properties which they are entitled to under the assignment agreement have been acquired, or their 180-day time period lapses. And so once one of those things happens, then we cannot buy any other properties for them. Exchange is finished, and any cash remaining can go out to the client at that point.
And that whole deal sort of dovetails in with the reporting of those funds too, if it's in a year, right? Because if somebody IDs something, we can't legally even give them the money till day 181 if they don't spend it.
Yeah, so if they have identified properties and that pushes them past the 45-day time period and something happens, then they're not able to buy those properties, then it may result in a second-year tax event for them. Yeah.
So it's not a simple, clean, straightforward situation. You got to ask the
Never is.
questions. I'm sorry?
It never is.
No, it never is. So let's look at, once again, I just mentioned, the podcast we did on the, is it appreciation homes, right? And that DTS situation, direct title security, correct? And you start looking at that, and I think, so I sent off a couple messages this morning because I don't know, I think my best in the shower for some reason, I think. But I thought, I think they need to talk to Troy Eckert at Oil and Gas, because, once again, you're sitting in a situation where, Troy's product typically is unencumbered. And so when people are doing exchanges, if they don't want to be adding money into the deal, they've got to find a place for the debt. And historically, we've sort of looked at, for example, Inland or Cantor, they have those 80% LTV zero coupon things that we've talked about a lot through the years. And that would be a way to pick up the debt if you're buying. So you'd buy, let's say, just for example, you want to put some money in oil and gas with Eckerd. That's going to be unencumbered, and you got to find a debt someplace. That 80% LTV situation could be taken care of with a zero coupon. But let's say that that's not that attractive to somebody. I think that the product that Derek has, that DTS, is a situation that's really interesting to me. And I like I said, I was thinking about it this morning. I said I gotta talk to Troy about this, and so I talked to Derek this morning and sent an email out introducing him to Troy and said, hey, this is an opportunity for you guys both to be working together. You're selling effectively competing product, but if you think about how they can work together, if they bury the money into Derek's stuff, and then that is unique because they have the ability to do that cash out refi virtually immediately after acquisition, and then take that money and go buy Troy's stuff effectively, or Wall Street stuff, or whatever it might be. So if somebody wants to diversify into Wall Street, that product could be a perfect solution for a lot of people. So with that said, I'm talking about a refi after acquisition, Tom. So what happens if I come to you and say, hey, I want to do a cash out refi before I sell a property versus a cash out refi after acquisition? How do those two things relate to a transaction? Is one something you can do and one something you shouldn't do, or?
Well, we've always taken the approach that there really isn't any timing before or after a transaction that the IRS says, yes, this is okay to do this. It kind of, what is your intention, as is the case with a lot of 1031 stuff, is intent comes into play. But if you were to let's say you've got a buyer for your property and you're negotiating this sale transaction's coming up, and you decide you want to pull some money out, and you do so through a cash out refi, that certainly is something that could end up being taxable to you, because it doesn't look like you ever intended to move what was in equity in your property into the new acquisition. It could be treated the same as if you had pulled money out of an exchange and taken that cash at closing. It might not be at closing, but
immediately
it can certainly be perceived as though that was the intent all along.
So if you do that, you better have some justification or reason that it had to be done.
Yeah, and probably better off if it's done before you ever listed it for sale or contemplated listing it, or better to be in a tax year prior to that in which you sold the property. There's certainly things that might play into someone's decision. Maybe they weren't planning on having to do this, but some other property suddenly needed cash and they had to go to this one to get cash, or whatever the case may be. But there's a lot of things that can play into it. But there is no set time period that is a safe time period stated, and certainly the longer beforehand, the better. Acquisition, I'd say kind of the same thing. You really want to put all your money. You have to put all your money in for it to be tax deferred going in. But there's a number of things on the acquisition side that might justify a refi, pull out cash refi on that. If you needed to do work on a property that you acquired, and that's always been, I think, considered pretty safe if you're pulling money out, but you're putting it right back into the property, and it's equity in the property. It's not like you're pulling all the equity out of the property. But afterwards, I think it's probably a little bit safer if you put everything in it, and then 6 months down the road, you have the need for the cash to pull out, and you do so. Maybe it's a more attractive interest rate. We've got falling interest rates right now, and if you bought at X and now the rates are X minus 25 basis points, it might be something that is very makes sense for you investment wise to do that.
It's sort of just got to be a separate event, right?
Yeah.
You got to spend it, get it into it, and then afterwards. So if somebody wants to diversify into Wall Street, they could do it using the refi funds, the cash out refi funds after acquisition, or instead of having 180 days to bury all the money into 5 different properties, if one would satisfy the exchange, they could then close on it, satisfy the exchange, and then they've got all the time in the world to go buy the other properties.
Yeah, and once again, you're probably going to wait a period of time before you go out and pull the money out of it. But you have to have a reason for it, or something has changed in the economy and it justifies pulling out. But typically, you do it in a different tax year. It's not something that you're certainly engaging with the bank to start this
double
refi
escrow
before.
basically.
Yeah, that certainly is not going to work.
I think the other thing that's interesting to me about closing, so the burying all the funds in the one property, doing the cash out refi after acquisition. The other thing that I think is interesting is, one, like I said, obviously you've eliminated the timelines that are necessary. But you've also got a situation where whatever you buy with the refi money, the basis on that's the purchase price. So instead of scattering your low basis across everything you're buying, you've got more depreciation effectively to take by doing that, using that refi structure.
Yeah. And I was going to say your point about combining something like a debt-free, whether it's oil, gas, or anything else, and combining that with something like the DTS structure or a zero coupon. A great percentage of the people that we do transactions with are buying multiple properties, and one of them may have a set structure, whether it be a debt-free acquisition, and it has to be purchased as such, like the oil and gas, or most all of the DSTs are a set loan to value, 50% loan to value. Or there'll be some debt-free ones, or there's going to be the zero coupons, which might be up there 80, 85% loan to value. But they all have a set loan to value. And if they're buying multiples, you might find one of those that they really want to buy, and it's not going to give them both the equity and the debt that they need, so they'll pick up something else to make up the difference. And it's a great point, because you can certainly combine these things to get exactly what you need. Planning.
Yeah. Planning. I was on the phone this morning with a gentleman that's a retired lawyer. He's got a bunch of properties with a group of people, and they're looking at, a couple of people want to go away, but all the properties are owned by the one entity. So, you're basically doing a distribution of the one that's going away to the two people that just want to go away, pay their tax, or have the ability to go do something else. But I was joking with him. I said, sure, nice to be able to talk to you today before the properties are ever on the market, when you're looking down the road versus the guy that's closing today with the same questions.
Yep, exactly.
Which happens way too often.
Yeah. The planning, I'm gonna jump. We're jumped a little bit. I was going to say we've got on here a topic of Section 121 and 1031 combo, and with the planning, I had this is something that's also very common. We have property transactions, exchanges that will utilize both Section 121, the primary residence exemption, and 1031 for a component of the property that is investment property. And it might be a property like a farm, where you've got an acre or a couple of acres that have the home on it, and the rest of it's all working property. Or you could even have a fourplex that the party lives in, the client lives in one of those units, and the rest of them are all investment properties. I had kind of the ideal client that had obviously done some planning with one of these recently. He just had it's a single family residence. He's got a construction business that he's had for at least 10 years now, and he runs the business out of his home, has a home office that his accountant has treated as a home office, taken depreciation over the last 10 years or so since he started this business. And, it's working out. He might not have thought when he bought this house that he would need such a structure in order to get out of this transaction without taxes, but it's worked out great for him.
So what do you mean by need? So, go forward where I know what you mean, but just...
Yeah, so he's got a situation where the property over the last 10 years has gone up significantly in value, and he's now able... His personal residence exemption, he's married, so he gets a $500,000 exemption, but his capital gain is far in excess of that. And so he's got, I think it's 20% or so of the home is allocated as his business property. So he gets to now take 20% of that and put it into a 1031 exchange, and that portion of the sales price will be reduced and so forth from the Section 121. So he's utilizing both the Section 121 and 1031. It's not getting him completely out of his taxes because he's got a huge gain, but it certainly is very helpful to him. And again, didn't know that was something when he started this that would really benefit him that much, because he probably didn't expect the property to go up as much as it did over the years. And that, we've talked about this all the time, that Section 121 exemption has been around since 97. It's $250 for an individual, $500,000 for a married couple filing jointly. And, for it to stay the same for the last 28 years now, almost 29 years is crazy.
It's nuts. And what's interesting, and correct me if I'm wrong, I was just laughing thinking about this the other day, because the only conversation that I can remember any politicians having regarding this topic was in the last, I believe, 6 months or so, and there was talk, I believe it was Green, the one that's now being sort of shamed or
MGT.
I think she's
MTG
leaving her post, but I believe she brought it up, and Trump sort of jumped on it and was talking about maybe taking and eliminating any tax on the sale of a primary residence, which would obviously open up the market dramatically, because so many people are trapped today and they're just looking at a situation, how do I mitigate the tax? So this 121, 1031 conversation is one that comes up all the time, and people come to us and is, well, gee, hey, how do I get out from under this? And one of the examples we give in presentations all the time, people that'll remain nameless, but they were selling that Los Gatos property, and they were referred in by their lawyers, say, hey, talk to these guys. And we told them to move out of the house, and they took a $3 million gain, would have been a $1 million tax hit, and went to zero. Bought, I think, what'd they buy? 24 different replacement properties, closed them all inside the 45 days, I think. So this topic that Tom just brought up is a huge one, and stay tuned to see what happens with that 250 and 500 numbers, which are woefully inadequate. So.
And with that, so David's talking about one of the strategies in order to either eliminate or reduce your gain exposure is to move out of that residence that you've been in that has such a huge gain and it's taking you over the 121 limitations. Move out of it, establish it as an investment property, rental property, rent it out for a period of time. Maybe you want to rent it for a year or two, or maybe it's working out great for you. You rent it for longer than that. But that's a way that now you can sell it and utilize 1031. And the great thing about it, if you do move out of it and you end up selling it within 3 years of moving out of it, then when the sale does occur, you can still take that $250,000 or $500,000 Section 121 exemption, because in order to take that, all you have to do is be able to look back 5 years and say, I did live in that property as my primary for 2 of these previous 5 years, and that will allow both the 121 and Section 1031.
So just as he's talked about converting a property that's going away or selling a property that has both 1031 and 121 components, we can complete the transaction and they can effectively reverse the process and move into something after they've seasoned it for a period of time. But there's some caveats to that.
Yeah, I mean, property has to be primary thing is, when in any exchange, the property has to be a property you intend to treat as a primary residence at the time that you acquire it. Primary residence. Let me step back and we'll edit that out maybe.
That's all right.
Property has to be something you intend to treat as an investment property at the time that you acquire it in the exchange in order for it to qualify initially. So that's to get into the property. After that, there really is no hold period requirement, which is kind of funny. If you look at buying into a property in an exchange that is a second home, then the IRS has this revenue procedure that they want you to follow that says that you've got to, for the first 2 years of ownership, you've got to receive a couple weeks worth of rental income. You can't use it personally for more than either 2 weeks for those first 2 years or 10% of the total time it's rented out. So it is something that looks like you have to hold it for 2 years if it's bought as a second home or a vacation home. If you're buying it just as an investment property, there really isn't any stated time period to hold. So you might buy it as an investment rental property, whether it's short-term, long-term, and then something changes in your life and it makes sense to move into it. So you do that, you can move into it. That's not a taxable event to convert it from an investment to your primary. After that takes place, it's not the same. I think what you were bringing up is it's not the same as if you had just gone out and bought a primary residence and you live in it for 2 years. Now you've got Section 121 open to you on a sale. With these properties that you have converted over to a primary from an investment property, those properties are treated differently. You have to own it for at least 5 years before you can start taking any of the exemption for 121. You have to, once again, live in it for at least 2 of those 5 years in order to do so. But then the IRS is not going to give you that full $250,000 and $500,000 exemption. They're going to go through a calculation, which gets a little complicated, but essentially they're going to give you a prorated exemption amount that is going to be figured out on the time that the property has been treated as your primary residence, you've lived in it, and that's considered qualified use versus the time that it's been an investment property, which is non-qualified use. And it's not just that property, but it goes back to property that you had held previously and can go back to, what's the year on it?
April of 09.
April of 09, yeah. So it can be, it's a good strategy if you want to get into a property that you're planning on living out your years in.
Your forever home.
Yeah, and because then you can hang on to it, and at the time of your passing, stepped up basis to your heirs. But if you're buying into a piece of property and you think that you can just live there for a couple of years and be able to take that 121 exemption, it doesn't work.
It doesn't work. We get asked that a lot.
Yeah.
And we still have people come up with the great idea to do that. So.
And it did work for people for a little while after this came out, but they caught on and saw that people were doing this, so they came out with the
they put the
rules.
put the 5-year hold in first, and that didn't stop it enough for them. So they put in the don't you love how they title these things? The Housing Assistance Tax Act of 2008 is what this is. So on the negative side, it slows everything down, and as Tom said, I mean, you're really never going to get the full exclusion limits, but it also ratifies the process of converting a property from investment to residence. So you can always hang your hat on that stuff. So understand these things. You might see an opportunity. There might be something that you can do for a bit of time, but sooner or later the IRS seems to catch on and sort of shut those windows down or make it uncomfortable. And I think the interesting thing to me is what you said about second home transactions, and really it's even more cumbersome than what appears, because you have to restrict your personal use to 2 weeks or 10% of the time it's rented, whatever's greater for the 2 years predisposition too. So you got 4 years of restricted use of these things, where if it's an investment property, you don't. So, talk to your tax people. I would just cease to treat it as a second home, and now it's pure investment, and then you've chopped your timelines down dramatically. So, once again, it's a planning issue. Don't do these things and ask for forgiveness. Do it, go into it with your eyes open, having your tax and legal people have those discussions. If you're having a conversation with us, and this is a thing that I think is really sort of frustrating to both us these days is we see more and more sort of people popping up on the radar that allegedly have 100 years of experience in 1031s and this and that, but they're AI-based companies and there's no interaction with them. If you look at the website, you don't see any physical bricks and mortar address. I mean, about us, it says nothing. Contact us says nothing. But the reality is, you don't know what you don't know. And a conversation with us, Tom and I put this company together in 1991 as investors. We look at this as not a tax or legal decision, it's an investment decision. That's why you do exchanges. And our position is that you really don't know what you don't know. I always jokingly say I'm happy to learn, tired of being taught. But a conversation, I jokingly say a 5 or 10 minute conversation with us can answer a lot of questions. But I mean, realistically, we've talked about this before on these podcasts. I mean, an initial conversation a lot of times is going to be a half hour, 45 minutes or more. And it's because people will come in thinking they want to do one thing and they end up, they don't know what is possible. And so to start looking at, why are you doing the exchange? I mean, CCIM, for example, we have that pitch session, the haves wants, the marketing people with money looking for a place to go and vice versa. But the question that never really comes up, and it's just so frustrating to me, is why is the person doing this? Why are you doing the transaction? What do you want? What's the motivation there? And then we can start tailoring the transaction.
Yeah, and they're not asked that question when they're contemplating selling. Everybody should be asking that question. And it's, what do you have? What do you want? And how are you going to get there? A lot of people have never had that conversation with their tax people, with their attorneys, and we do ask a lot of questions when people call in, and sometimes people are sort of reluctant to get into the conversation, but it seems like these conversations will go, as you said, they'll go half hour, 45 minutes or longer, and it seems like it goes by pretty quick because there's a lot of information that starts flowing, and people start getting ideas. So we start asking questions, and that triggers them asking more and more questions. So they get a lot out of the conversations.
Well, you think about through the years, I mean, just think about what we just talked about with converting assets, buying a property and converting it to primary residence. Okay, that's there, and it's possible you can convert your home into an investment, so on and so forth. But if you look at the acquisition of a property that's ultimately going to be a primary residence at some point in time, I mean, I think through the years, if I think about the smallest transaction or smallest amount of gain I can ever remember being deferred in a transaction, it was probably 30 years ago with a CPA we were doing a deal for. This gal had like a $5,000 tax hit, and she was insisting on doing the transaction. And it's like the opportunity cost of the exchange is there. So. Yeah, but then on the other hand, I can remember a guy probably in the late '90s, $800,000 gain. He said, "It's only $800 in tax, not gain. It's only $800. I'll just pay the tax." So I think you and I, through the years, we've taken the position we're never going to judge anybody based upon their decisions on these things. Everyone's in a different spot. Maybe he had, to the point of our conversation earlier, maybe had losses to offset the 800. Who knows? But if you think about the opportunity cost of transaction, this is where people might not want to talk, but if they don't talk, we can't help. And I always say it's like a lot of people in today's world have their hand out for your business. They're reaching for it, they're wanting it. And if we put our hand out, it's really not, we want your business, but we're not asking you for something. We're really looking at, we're going to be your partner in this process and help you get where you want to go. So that's when we put the hand out, it's a hand of help, not a hand of need. But if you look at the conversion of a property that's acquired via 1031 converted to a home, the next logical question is going to be, well, what's the tax liability and what's the opportunity cost of that hold period? Because like you said, maybe it's a year that they need to be living someplace else. Where is that? Where are they living? If it's Miami, a year's lease living someplace else might cost you, $100,000, right? I mean, so what's the tax hit, and does that exchange make sense, or do you just bite the bullet and go buy what you want and move into it immediately?
Yeah, that's a good point. And sometimes leasing out another property makes great sense, and other times it makes no sense. All depending on what you're saving in taxes, and maybe somebody's going someplace that they don't know exactly where they want to live anyway, so they'll lease out a place for a bit, and maybe that property that they bought ends up not being ultimately what they want to move into after they've been in that area. So, yeah, a lot of things to consider.
Yesterday at Rotary, I had a presentation by a gal that was a feng shui expert for a decade or so, but she's been a real estate broker, works with seniors for the last decade. And when I walked into the meeting, I didn't realize what the presentation was. I saw, it was a broker, and I thought it was just going to be another presentation by a real estate broker, selling us on her, right? And really, she did a great job, because it was talking about at the end of the day, your home and seniors, and just changing your home, what you shouldn't do with the stuff, but downsizing, the cost of downsizing, interest rates. You made a comment about the rates coming down. Did the announcement get made? Because we're waiting for an announcement today on interest rates.
I'm just expecting that they probably will,
but she did a great job on it, and we have people trying to do these lateral moves, or maybe they're taking the house that they built for the kid to raise a family. Now they don't need that. They got the McMansion. They don't need it anymore. Or maybe they're going from 2-3 stories and want one so they can move around, so on and so forth. But with the interest rates being where they were, you might be buying a much smaller house and having the same payment in a lot of cases recently. But the reason I bring that up is I was thinking, because she started talking about some of the senior living properties where you're some are leasing and some are buying, right? And I was just thinking, if for somebody who wanted to plan way ahead, I mean, I don't know if the senior housing place, if you can buy a unit that you're not going to occupy, or if it's got to be owner occupied. But I was thinking that would be a nice sort of end game. You could buy the senior housing deal that ultimately you were going to move into and age in place, but you've got it as an investment property until you do that. Anything's possible, like Sheila likes to say.
It is.
Yeah.
It is.
So ask the questions.
Yep. People might be living in a multi-level property, and they need something in the future that's going to be single level and in a different area. Maybe it's a warmer climate or something, whatever they might want or need, and they can acquire that through the exchange, hold it for a while, and end up moving into it if they so choose in the future.
Yeah. Anything's possible.
Anything's possible.
So one other thing we haven't talked about, this is sort of just our sort of year-end sort of wrap-up thing. One of the other things that keeps coming up is seller finance stuff, and we've got a video on our YouTube channel. If you're curious about it, you can take a look at it. Because there's just so much misunderstanding with seller finance and what the tax liability is and so on and so forth. But if somebody is going to carry, let's say, a note trust deed or a land sale contract, and they're going to be the bank, but they want to do an exchange. Just quickly, do you want to run through the options available to somebody? Because a lot of times they might be told you can't do seller finance to do an exchange. It's possible, and we've got 5 different ways to do it effectively. But you want to hit those real quick?
Yeah, because the first thing to realize is that if you get a note, if you're going to act as a bank, if you get a note out of that transaction at closing, then that's something that is not like kind of real estate, so it's taxable. It again is boot, and you're typically going to get an installment sale treatment on that. So if you receive a down payment and you have the note, the down payment could either, if you're not doing an exchange, it could be it'll be taxed at the time that or in the year in which the sale occurs, and then the note payments would be taxed as you receive them. principal is going to be taxed as ordinary income, or excuse me, principal is going to be taxed as capital gains, interest is going to be taxed as ordinary income. So you might have interest payments for a while that's going to be interest income to you, and then you've got a balloon payment in the future. If that's the way it's structured, you pay capital gains on that. If you're doing an exchange transaction, you could have a partial tax deferred exchange by just exchanging the down payment. If that down payment is a significant portion of the sale price, and you're going to get taxed on it, you could certainly do an exchange and just utilize that in the exchange and take the note. Again, you may end up paying taxes on the full capital gain, depending on your note amount and what your capital gain is, but you do so over the years as you receive the principal. If you want to have full tax deferral, then not only at closing, not only the down payment needs to come in the exchange, but the note itself needs to come into the exchange. So that note is drafted with us as the facilitator as beneficiary. So sale closes, Equity Advantage receives the cash proceeds portion, we receive the note as the beneficiary, and then the client needs to convert that note either through a sale or another avenue into real property. Those avenues really are going to be after we receive the note, they can come into the exchange and buy it from us. Essentially, they add cash. If we're holding a $500,000 note, and maybe they've got $500,000 sitting in a money market account that's earning 3% if they're lucky, or they could buy the note from us, and maybe the note is 7-8% or so. So they could add the cash to the transaction. We then assign the note over to them. Now they have a $500,000 basis and a $500,000 note. The only thing they're going to pay taxes on is going to be the interest income as it's received. We now have all cash to go out and acquire the replacement property, so you can get full tax deferral that way. That's what's most common, is if the client's buying the note from us. In the past, we've done transactions where the client has arranged for a third party to come in and buy the note from us. I don't think we've done one of those for quite a while, because typically the note gets discounted pretty heavily, and it might not make sense for them to do that at all. They might be better off paying the taxes.
I can't remember one of those since the 90s.
Yeah, it's been a very long time.
Yeah.
But back then, even it was pretty common for them to be discounting at least 25% on the note, and so
consider the tax liability versus the discount. So
yeah, another way that they can utilize that, again, not something we see, but it is a possibility, would be for the client to negotiate with the seller of a replacement property, say, will you take cash and this note? And if the seller agrees to that, then at time of acquisition, we've got the cash and we get assigned in as the buyer. So we are transferring the cash over to the buyer through escrow, and we are assigning our beneficial interest in that note and trust deed over to the seller of that property. We've done a couple of those over the years, but it's pretty rare. It'd have to be a pretty attractive note, once again, and usually the seller's not going to know that property,
nor the buyer.
Yeah. So
they don't. We did one years ago that was cross collateralized, right? I think our taxpayer, they were working with, I think it was Bill Buckley, who was a real estate lawyer at that time. I think he cross collateralized the note with the guy's house, I believe, and that made everybody comfortable.
Yeah. So there may be some other ways that they can structure that, but it's going to involve some attorneys probably to do that. But really, those are the ways it can be purchased from us, either from the client or from third party. It can be passed along to the seller of the replacement property as partial payment. Am I missing one?
Well, exclude it from the exchange.
Yeah.
Buy it, sell it to somebody else, or short term. I mean, maybe it's there to get a deal done, and it's going to be retired immediately thereafter with a different LTV or whatever it might be.
That's what I'm missing.
Yeah.
So that if it's a short term, the buyer can't get either they can't get financing, and we've done a lot of these over the years just to save a transaction because we're either bumping up against the 180-day mark or something else. Maybe the buyer is not able to get financing for this acquisition right now, but it's not a problem for them to refinance the property after they buy it and pay that note off. So we've had transactions. It's a very short-term note, and if we are the beneficiary on the note at closing, and that note pays off prior to the acquisition of the replacement property, then it's just a payment to us. And so, yeah, that certainly works.
It's another opportunity and a solution available to people. I think the thing that you've got to really keep in mind, back to Tom's comment on the discounting's going to be based upon the value of that, how hard to note that thing is, right? But I cannot stress this enough to you. If you sell and carry paper, it's your paper. So don't let the nice buyer and their lawyer draw the thing up. So that paper better not be at market rate. And we had somebody in here, I don't know, the last 6 months came in and they were looking at a seller carry. It was their note and it was under market rate. And I'm going, why is it at this loan rate? I mean, if the bank's going to charge, let's say 7 or 6.5 at that point in time, it should be 9 or whatever it was. I mean,
it's always the seller's doing the buyer a favor, and it ends up coming back to really bite them hard because they may not be able to do an exchange to begin with if that's the case.
So in this situation, I asked him, well, why is it there? I said, well, the buyer won. I said, well, these are the problems. So I went through the scenarios that you just did, but I said, look, the interest rate is ridiculous. And the other thing that comes up is, back to my comment on it's yours. If you're the seller, it's your paper. You better have an acceleration provision, and it's something saying, because if you're doing it as an end game, like Tom explained, the taxability of an installment sale, you got to understand, one, what the tax liability. If you're selling unencumbered dirt, then you're not going to have tax on debt relief and depreciation recapture in the year of sale. But typically, most of our clients have encumbered improved property. So you're going to have those things. So one, make sure you're getting enough of a down payment to cover all of that, including the closing costs. But you got to understand what the tax liability is going to be. But if you're agreeing to carry this thing, it's your paper, it better reflect your best interest, which means have an acceleration provision in there, because if you're doing it with the idea you're going to get 10 years of income and it doesn't have an acceleration provision, and 6 months from now there's another drop, it gets balloon payment, or the buyer's selling, now you got a problem. The other thing you better have in it is a some type of clause prohibiting assignment or blind assumptions, because we've seen people selling with no prepayment and with blind assumptions. So you might like the buyer today, but if they turn the property, now who's paying you? So it's really, sorry I get so up about this, but it's just one of those things where it's really been, I really feel as though that seller finance instrument, and you and I used it all the time, anytime we could when we got started, to buy stuff, because it's great for buyers, but for sellers, I really feel like a few of our clients, it's sort of been elder abuse. I mean, because the nice buyer and their lawyers doing these things, and the seller they're being told something that's not right, and they have no idea really.
Yeah, and they might have, some of these properties might be properties that are not financeable. Yeah. That was probably some of the cases with some of the properties we were first buying. But,
it was the case.
Bank's not going to finance that.
Yeah.
But yeah, so sometimes they don't have a lot of choice in the matter as a seller. But if it's not something that you're going to want to do as a favor to the buyer in most cases. And as you said, if the property is financeable, but maybe the buyer's not financeable, then you better be getting a premium for that note.
I was telling somebody the other day about that deal with that deal we were looking at in Salem, Oregon, where there was this 27 properties for $540,000. That was 1990, people, but even at that point, it was cheap. But I just remember riding around in the back of that broker's car, bouncing around, going through a nice neighborhood, saying, "Oh, this one's going to be really nice," and then we go across the railroad tracks, and there it is.
Well, in the railroad tracks, we also joked about the fact that we could probably visit all of the houses by railroad anyway.
By train. think you're right. And remember how disgusted Dad was that we didn't want to buy the stuff?
Yeah. Yeah. I think we're looking at it going, maybe there's like 3 or 4 of these houses that are worth keeping, but the rest of them.
Well, why don't you buy them? Yeah, says the guy, because Dad he'd always like, well, I want to buy something nice enough that I can drive by with my tennis buddies. And oh yes, these were not that type of pride of ownership
It
property.
was not pride of ownership for sure.
Which Ron would say, hey, that's irrelevant. It's all about the ROI and the numbers. But anyway, hey, this has been fun today. We covered a lot of different topics. We're sort of applying the top of mind philosophy on this presentation. So sorry to you if you're a little confused what these guys talk about. But I think it was fun.
Yeah, and as always, if you've got questions about anything, call us up or email or comment on these things, and we'll definitely get you some personalized answers.
Well, thank you very much for spending the time with us today, and it's Christmas of 2025, so Merry Christmas to everyone out there, and Happy New Year, and we look forward to speaking with you soon.
Yep, thank you.
Dave and Tom Moore, the Exchange Bros, Equity Advantage, 1031exchange.com. Thank you.